Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm 𝗤𝘗𝗀𝗃. With me as always is Mark Ainley. Mark, how are we doing over there?
What up, Tom? I'm doing good over here, but
well, that's a new reply from you.
Yeah, I know. I had to go unique today, but you know, I saw the post that you had up there, and Javier made me look at it a couple times because he was so impressed by it. Javier, anyone listening, is the person that's handling the marketing over at GC right now, but what you're doing over there in Albany with the trusses, like that's like a new. I mean, that's a whole nother level of gut rehab that you're working on. So I'd love to hear more about that.
Yeah, well, first off, I'm not doing anything. Chris does everything. So to be clear, but I get, there were a few comments on there. So I guess I just want to explain the concept here. So, we're talking about open web trusses, and I'm not Mr. General Contractor by any means. But it really makes sense when you're already going to be gutting a place. So the whole concept of the open web truss is they have a higher strength to weight ratio. They can do longer spans. And what that means for you is you don't have to have poles coming in. You can have a completely wide open floor space there. So if you're doing open web trusses for, the second floor, that first floor is wide open. You don't have to worry about poles. And so when you're doing these guts on these, bigger buildings that you're going to sell in the seven figures, it gives you that freedom to design very open spaces, right? Like your architect or your designer is not limited by anything. It's also cool as you remove walls, it becomes, the first thing, it becomes more difficult to install mechanicals, but with the open web trusses, you can actually run the ductwork and the plumbing in there. So you don't have to worry about running things through walls. And it's smoother, it's clean, it's definitely expensive. But if you already have, hey, these joists are smaller, we already got to take care of a lot of the framing or whatever it might be. It just gives you that complete openness. So I hope Chris is probably listening to me like, shut up, you idiot. You don't know what you're talking about. But I think I did a very good paraphrasing there of the open web trusses. We've done them on a few projects. That Albany one, though, is the first time we're doing it for both floors. So we're doing it from the basement to the first floor and the first floor to the second floor.
Like how much difference is that in 5% to what you have? Like how big of a difference? And is it really just the shock and awe when someone walks in and sees the floor plan? That's the total benefit of it?
Yeah, I guess so. To put in perspective, we did one at like an 800K. We had two projects that were both like in the 800K ARV range, and we were torn between them. One we did it, one we didn't, because the original layout was pretty decent. So, and then once we're getting into these bigger ones, it's almost a necessity. And for my house, the one we're doing next door, we're doing a complete new second story, that wasn't there, it was just a little attic space. So we're doing it there as well. So my first floor will be open as we just discussed.
That's pretty cool. It's Legos to a whole nother level. I love it.
Dude, it's cool. They just have a giant truck come and deliver these things. Yeah. And it just blocks up the whole street and all the neighbors get pissed at you and you take a day to get it all delivered and set up. But it was pretty awesome.
Oh, that's awesome. That's exciting, man. That's cool.
So we'll link to that video if possible. It's pretty cool. It's just cool to see a building sitting at the basement, looking up and seeing the ceiling.
That's what I loved about the pictures you posted so much. That was really cool.
So cool. What do we got for a housing provider tip of the week?
All right. So housing provider tip of the week. I've talked a couple of times about being conscious as a landlord, responding to no heats and making sure you're on top of your maintenance for the winter months. But the dichotomy of that is, make sure you're not running out there when you truly don't have a no heat issue. So one of the things that we require when somebody calls in a no heat is to take a picture of the thermostat. For us, we have some tenants that like it hot. So when it is 78 degrees and it's not going up to 84 for them, they call no heats. So to make sure that we're not sending technicians or HVAC guys out to solve problems that don't exist, we make the residents send out pictures of their thermostat as part of the work order process. The other thing that also troubleshoots as well too is when they send a picture of a thermostat, it's blank. Then right there it's a battery issue, and you could probably solve the problem with just putting a new battery in without having to send somebody out there. So that's my tip of the week. It just kind of do a little troubleshooting around the no heat right away. You got to do it fast. You can't take 2 days to get a picture from it, but you might be able to prevent having to send someone out there and pay a service charge.
I dig it. Good one. All right. Today's guest, Mark, we got another U of I grad. I'm pumped. We got our Illini ranked 14th or 15th, I believe, for basketball at the time of this recording. Hopefully we're still up there, or if not, at least climbing the ladder.
Well, so for all you listeners out there, I went to this week to kind of look into today's guest a little more online, and maybe I know someone knows him, but right away, first credential I see is went to U of I. I'm like, oh, that's like it was a given. So I found that pretty funny.
So our guest today, he spent the first half of his career as representing sellers in the multifamily space and quickly became one of the top producing and trusted brokers in the city of Chicago. He then launched into large scale national developments. So we're talking institutional money, where he built out a robust pipeline of over $3 billion. That's with a B. Jumped from broker to development, as I mentioned, and now is the principal over at Wildwood Investments. So without further ado, Matt Katsaros, welcome to the show. Matt, how are we doing?
Doing well. Thanks for having me.
We're pumped to have you, man. This is good. Not just the U of I connection, but everything else.
Yeah, absolutely. Absolutely.
So, all right. So let's start. You come out of school and we jump into the brokerage side. What attracted you? You know, because that's a tough job. I have such empathy and just such respect for these brokers who are just banging out calls and then trying to broker deals. And it's tough in the multifamily space. Like, what about it was attractive?
Yeah, well, I did spend a year, it's not on my website, but I spent a year in lending. And it was a time when commercial lending was a little slow. And the small bank I worked for was not doing much volume. And through a U of I connection, I had two friends that were fraternity brothers of mine that ended up at 𝗫𝗃, which, if you don't know that firm, it's a large investment sales firm in Chicago and national. And at the age of 23 or 24, they were busy. They were active. To your point, it wasn't easy, but they seemed excited when they talked about work. They were competitive with their colleagues, and they just seemed to have a lot of fun. And I was sitting in an office in Frankfurt at a small bank, not lending. And so it seemed like a good competitive move, a challenging one. And of course, they sold the dream that there was a good amount of money to be made as well if you got good at it. So that was fun. And I think it attracts, people that are competitive. And that's kind of what I wanted. I didn't want to be sitting in a cubicle anymore, kind of staring at the wall. So made the move over.
Got it. So you get there and it sounds like we rise to some success here. Did you have a specific niche? Like, were you focused on a specific type of asset or a specific class? Like, where did you cut your teeth there?
Yeah, so I went through kind of the formal training, and then they assigned me to a senior broker. I worked with a broker named 𝗬𝘃𝗲𝗀𝗃𝗀𝗀, and then his wife actually was also a top broker there named 𝗬𝘃𝗲𝗀𝗀𝗀. They later formed 𝗬𝘃𝗲𝗀 Group, which I went to. If you're familiar with that firm, they sell only multifamily. So really, from the start of my brokerage career until today, I've always been in apartments, either selling them, buying them, or now building them. Really hit the ground running with calling landlords. And, we had call counters, and we had to call, I think it was 200 calls a week. Those calls only counted if you actually talked to somebody, not left a voicemail or hung up when the machine picked up. So it was a lot of cold calling and meeting people and learning and trying to get people to wrangle their buildings loose from them. But I worked for a very good team, so I didn't have to kind of start from scratch. And I think that's important to have a mentor when you're in your young 20s trying to, sell buildings for folks.
Yeah. So just quick comment for our listeners. If this airs in December, you'll be hearing a ton of Kaiser Group sponsorship as they'll be sponsoring us in Q1. So you'll hear Lee's voice all over the podcast here.
Small world. Yeah. Small world.
So, all right. So we're having success there. At this time, are you investing at all? Or are you strictly just on the brokerage side? You're strictly just working on the commissions?
Oh, that's a good question. I actually bought my first 3-flat a year out of school. I rented for 1 year, and then my close friend and I did a 50-50 partnership, and we bought a 3-flat at 3239 North Damon, which we still own. We lived in 1 unit, rented out the 2 units to our friends from school, which made it kind of a little bit of a frat house, I guess. But it's always fun collecting rent from your buddies, as long as you're on the collection side. And we did that for a few years. And then as we got serious with our girlfriends or current wives, we kind of turned it into a true rental building, duplex down the first floor to make that a 4-bedroom, which was the unit we used to live in. And we've had it rental ever since. We did a little bit of kind of, I guess, call it owner-occupied investing at a young age.
That's awesome. A great way to get started. What was Tony's there at Belmont and Damon, or no?
Tony's was there.
Still hanging. Made it through the pandemic. I was pumped.
Yeah, we spent a lot of time with Tony's. A lot of late nights.
Anytime I'm coming home and I'm going westbound Belmont, that is the stop. If I've been out that night, that is the stop going back to the northwest side.
Yeah, very good people there too. They're very friendly.
All right. So Tony, make sure you link to that in the show notes here. All right. So we have an investment under our belt. We're working at the brokerage. We're going to get into, you're doing some like large, just institutional size development. You're doing some in Chicago as well. Obviously there's a transition there, right? That doesn't happen overnight. So talk through what attracted you. How do you make that leap? What happened?
Yeah. So after 10 years as a broker, I kind of decided I wanted to just try something different. It's a great business, but it's a bit repetitive, and some people do it for their whole careers. Others kind of transition to the investment side, I think, after a period of time. And that's what I decided to do. And there was a step there in between brokerage and kind of that institutional investment you mentioned, which was, I worked for a company called Pangea Properties. And Pangea is the largest owner operator of apartments in Chicago on the south and the west side, primarily. We bought a lot of property in the pandemic. I should say pandemic recession, 10 years ago. We've been saying pandemic so much, and most of the stuff we bought was vacant. So when I was there, I think we bought about 5,000 apartments in Chicago. I would say, again, 90% of those were vacant buildings. We would do full gut rehabs, all new, mechanicals, all new systems. So it was kind of a good transition from selling buildings to rehabbing, which is development, right? It's development. So while we were acquiring, it was still development. And then from there, after just tons and tons and tons and tons of rehab, I was recruited over to 𝗖𝗵𝗶𝗵𝗁, which is my previous company, because they saw kind of the amount of deals that we were doing, and they wanted somebody that could kind of handle volume. That took some time. That first year there was tough to learn how to underwrite high rises, to learn how to understand entitlements for high rises was challenging. But they had a really good team over there, and kind of figure it out as you go. But that was probably the hardest transition I had to make, was going from smaller rehabs in the neighborhoods to understanding high rise development. And then what I'm doing now is kind of a blend of the two, I guess.
So you've had all these different positions up to that point, and all real estate, but very different areas of it. Like coming out of school, like what were you planning on doing coming out of school, or what would you, when you grew up, what you want to be? Was this part of a plan, or this kind of you end up here on accident?
It was an accident. I think I was in finance at 𝗖𝗵𝗶𝗵. I think I wanted to be a banker, whatever that meant. I think commercial lender was probably the route I was on, which a lot of kids coming out of 𝗖𝗵𝗶𝗵, they're either going to accounting or they're going to some sort of finance. But there was a lot of folks that went into the track of kind of credit analyst and then junior lender and then lender. And that was kind of the way I was going. I was never interested in investment banking or private equity or anything. I wasn't smart enough. And then I just kind of landed at 𝗓𝘃𝗏𝗃 and then got the bug for the apartment business. And once you get good at it, there's really no reason to leave. I mean, I think the modeling of a 3-flat to a 30 unit to a 300 unit, it's all the same, right? It's all your assumptions. It's all your inputs. The models get bigger and more complicated. The deals get harder to structure. The equity gets harder to source. But if you can understand the assumptions that go into a small building, it's the same as a large building. It's just, obviously multiplied 100 times. So kind of once you get good at apartments, it's hard to shake the business because it's a niche that not most people understand. And I think there's longevity in it because there's always gonna be apartments, right? They're never gonna go away. And there was a secular shift from condos, probably when the three of us were, maybe in our 20s. I don't know how old you guys are, but where everyone and their mother and sister and brother wanted to buy a condo. And once that shift after the recession went to almost everyone being a renter, including the whole millennial generation, it made a lot of sense to stay in apartments. It seems like anytime there's a setback, apartments seem to come up first, right? Like industrial's killing it, but apartments still seem to be the darling of the industry, I think, for a lot of people.
Yeah, it's crazy going through the condo conversion and into the condo deconversion, like going through both phases of that. And it is really in such a short span of time. And the amazing thing is the history of a condo, I'm going to sidetrack here for 2 seconds. This history of condo is pretty new in the history of the world. Like condos really became something like back in the 50s and 60s. So then to see it kind of these transitions go back and forth is kind of funny in such a short amount of time.
Absolutely.
So you worked at Pangea, and I've always followed Pangea and their success, and what an amazing company, and to be able to they're like the mecca of scaling from what I know.
Right.
Like, I mean, what they're able to do with in such a short amount of time, like what are some takeaways you took from working from a company like that as far as that's kind of helped you bridge to where you're at today?
Well, I was brought over there by 𝗬𝘃𝗲𝗀𝗃, who is still the chairman and was the CEO at the time. And, you know, for those that know his story, you should look him up. He's scaled multiple businesses. So he chose real estate because he had a lot of experience from his prior businesses, which included lending in and around some of the communities that we bought in. And he was just, I think he saw the amount of distress in those markets during the recession and how much opportunity there was to scale, because it's very hard to scale in real estate. It takes most landlords that you see that have, you know, 2,000 even apartments have usually built those over maybe two generations of families, right? 30, 40, 50, 60 years. I think that he saw the ability to scale to that size pretty quickly because of the areas and the fact that we're in a recession. I think the most interesting thing about that company is it's structured as a private REIT. So the money doesn't have to come in and go out, right? It gets recycled. So as you grow, rehab, refinance, pull money out, you can continue to use it and buy and buy and buy and buy, and you don't have to ever raise more money. You know, my deals currently in most, I shouldn't say most, well, a lot of the development you'll see out there, or even syndications for acquisitions are, you know, money in, and then there's some sort of a liquidation event, and then you have to raise more money the next time. Pangea wasn't like that. So as long as we were able to buy right, you know, buy for 10,000 a door, be into it for, you know, 40,000 a door, but then get debt of 30,000 a door, you know, on it, you could just continue to scale. And that was the model. I think we raised $120 million in the first REIT. There were two different ventures. I think it was 120, maybe 80. It just allowed us to continue to buy. I mean, I never had to worry about money as the head of acquisitions. I just bought. And at most companies, you have to worry about where's the money coming from, right? So he structured it in a way that was taken care of day one, and it allowed us to probably be the fastest and all cash. We were always all cash buyers. We were always fast. We had zero to no contingencies, and then that puts sellers in a position where they want to work with you. And so we're just gobbling up portfolios from banks. A lot of those were note packages. It just was a very unique situation. When you have money and no one else does, like in the heart of a recession, you become the best buyer, and that's why we could scale.
I'm going to dive deeper into that, the Pangea experience, because so yes, you get timing was everything for that when it comes to the acquisition part and the cash and be able to recycle and do that Burr type strategy on a large level. It was awesome, but the fear people have of rehabbing a 3-flat, let alone 30,000 units, like what was it? I mean, I don't even know how you'd find enough general contractors at. Like, where are any kind of tidbits you took away from like mass scale development of that level from your experience there?
We had really, really good PMs. I was less involved on the construction side of it. I had to underwrite it. I mean, when we would walk the buildings, we had a clipboard, which we later put into a program, which didn't work great, but the simple idea was, you know, as a deal guy, we had to note all the issues with the building. We always had contractors with us, right? We would do a schedule, and then they'd obviously qualify. But all these buildings were pretty much the same. I mean, if it's a courtyard or a corridor or a 6-unit, you know, center entrance 6-unit, once you kind of do like 4 or 5 of them, they're really all kind of the same in Chicago because they're all built in the 20s. You know, obviously you got to make sure you're not missing some big ticket items like structural or a roof or stuff but we were doing everything. And so we kind of had the model down. How we got the amount of people we had, I don't know. I mean, I think everyone that Al went to high school with was working at Pangea at some point. And, you know, two of our head PMs were his buddies from high school. They got their cousins and brothers on board, and we grabbed every guy we could off, you know, sometimes it was street corners to help with the rehabs. At one point we actually did go to kind of a larger, never a union type scale, but when we went to Indianapolis and started buying garden style, which were 200 and 300 unit buildings, we had to start to hire some larger scale, you know, GCs that had 40 or 50 guys, and they would do those deals for us. But I would say at any given point, I don't even know, we probably had 200 or 300 laborers just churning through these buildings. Yeah.
That's awesome.
Yeah.
So I want to go back to the money point for a second. So it's awesome, able to get the investors, able to figure this out and just scale quickly. But it's one of the hardest points for our listeners, right? They buy their first building, They wait a year or two, they buy the next building. They wait a year or two, they buy the next building. And they're just saying, how do I 10X this thing? So was there anything from that Pangea experience that you can share with someone working on a much smaller scale? Like any tips you can give where those learnings can be leveraged for someone that's just trying to go from, call it, 5 units to 50?
Yeah, I mean, I don't think it's quite apples to apples, because again, we raised all high net worth capital from a guy who just had scaled another business and stuff. I think on a smaller level, the way that people have had success is to be able to, obviously improve the value of the property and then pull out the equity, but hold the property versus selling the property. And I think a smart way of doing that is to work with smart lenders and make sure your lender understands appraised values. And before you even start the project, understand what the final value is going to be, right? Understand what your final loan to value is going to be. Are you going to get 80% at the end? Are you going to get 70% at the end? What's the recourse going to be? What kind of a loan are you going to put on it when you're done? Is it going to be a Fannie Mae loan? Is it going to be a community bank loan? And when you can and then what will the bank allow you to take out all of your proceeds?
Yep.
So if you buy it for 500 and put in, 200 and it's worth $1 million, can you take the 700 out? Or will the bank lender say, no, we're not going to do a full cash out refi? So
yeah,
I think
they want you to have skin in the game and some other clause or whatever it might be.
Right. Maybe they'll give you 60% and they get half your money out. So you kind of have to understand what the lender at the end is going to do just as much as what the lender in the beginning is going to do, because the acquisition loan, everyone thinks about, how do I get a loan? How do I buy the property? But if you can get your money out at the end, that's the kicker, because then you've got the money to go buy the next one. If you have to wait to accumulate your own personal nest egg to buy the next one or raise money from someone else, that's a little bit tougher. Easier said than done these days. Buildings are more expensive now than they were back when people could kind of do cash out refis maybe a little bit easier, and leverage is higher back then, which was a bit of a problem. But I would say understanding your end loan is very critical. Just what can you do at the end of the day?
Yeah, and I feel it's missed by a lot of people too. You have all this time, right? You're doing the rehab, you're doing all this work. Like, you have so much time to get your ducks in a row, to interview people. If you don't have established lenders, time is on your side there. Like, go ahead and talk to as many people. Just because you met one guy at a meetup, well, if he's giving you, 75 loan to cost, and some other guy will give you 75 on the ARV, like, those are two wildly different loans, right? Like, it's just know your options, or at least go find the options. Go talk to someone who's done it before. So couldn't agree more. Yeah,
absolutely. Your model should have your current underwriting with your current debt. And it should also have what's your buyer going to look at if you're selling it, or what can you do for the refi? Those are kind of your options, right? And you should understand that end value and what you can do at the end.
Yep. No, absolutely. All right. So let's just jump back into some of these bigger developments you're doing. So maybe you can walk through a specific example, but what I'd like to do is if you can articulate just the walkthrough from, hey, we're looking at a deal, like the cycle of raising money, acquisition, bringing it to market, right? It's a much longer horizon than probably a lot of our listeners are used to. Mm-hmm. And just how that difference from, I found a 3-unit, I fixed it up, and 6 months later, I got my, I'm looking for tenants. Just talk through like how you find these deals. Is it all through brokers, and how do you raise money? Just let's start there and take the conversation from there.
Yeah. So when I left CA, it was we can call it a pandemic company, I guess. I was grounded from flying, and all of our deals were outside of Chicago. So I partnered up with a general contractor. That was step one. He is also a developer. His name is 𝗵𝗶𝗵𝗵𝗶. Company's called Contemporary Concepts. And he was kind of doing what we're doing already. So I didn't have to start the business from ground zero. Our idea was, let's partner my strengths, which is kind of finding deals and capitalizing them. And his is building them. So we formed a joint venture. So that's what we're doing. And our thesis was try to build 30 to 100 unit buildings out of wood frame construction. And we wanted to keep it under 5 stories. 5 stories or under. And that's what you can build wood with in Chicago. Meaning your walls are wood, you're not doing a lot of steel, you're not doing any concrete. And we wanted TODs, so not a lot of parking. And all of those, when you formulate them together, that was the highest returns I thought I could generate from an apartment deal. Higher than doing a high rise, higher than doing a garden deal in the suburbs, higher than doing 3 flats. It was kind of this infill, corner locations, good, Lakeview, Lincoln Park type areas. And so we built a model that we thought would work, and then we had to go find deals. And so I reached out to a lot of brokers I knew that were kind of quieter. I mean, if you go to the big firms, you're not going to necessarily ever see something that's as interesting. I don't think you're going to be competing. A lot of my old friends are brokers, and we quickly hit the ground running. The other thing you have to think about when in new construction is a little bit different than some of the rehabs is zoning is critical. I know that when you add on to buildings and add on to homes, you have to consider zoning as well, obviously. But we were really focused on as of right, meaning we could build what the zoning allows, or knowing we could get something zoned, which is not as easy as it used to be either in Chicago. So I'll kind of pause there because I know it's a lot of information and I don't want to get too crazy into the whole deal cycle. But really it was, and this is what I would say for any investor, is build a model first, right? Don't find the building first. Like, understand what you're trying to accomplish and then go find that. And that's kind of what we did. And then we went out and we've since have found 4 sites in the last 12 months that we're working on.
All right. So love it. Ton to unpack there. So one question I have is, when I see these big developments going up, and you talked about being zoned as right, but you still got to go through the process, right? In other times when it's not, and you got to have the aldermen, the meetings, all that fun stuff. What's the order of operation there? Like, are you putting it under contract and then rolling the dice that all this will come through? Or is that part of the due diligence phase where you're giving yourself X amount of time to see if what you want to accomplish can actually happen?
It's a very good question. So generally speaking, you have to somewhat overpay to get a zoning contingency, meaning you're going to convince the seller that you're going to pay them more than they could get with the current zoning, but you need to have the time to go get the zoning.
Got it.
Okay, so they kind of need to understand, all right, I'm going to give this guy, 9 months, maybe 60 days for fees, maybe 60 days for due diligence, just like your inspection and your geotechnicals and your environmentals and all that stuff. That all come back. If that all comes back okay, and you can actually build a building on the site's okay. Then you go into zoning, and the city of Chicago in the last year has been a little slow because of what's going on. We actually we did a rezoning in Tom Tunney's ward that was very smooth. It was all over Zoom. It actually went pretty fast. We did it within 6 months. But it's a zoning contingency because if there are some developers that'll buy land, what we call unentitled without the right zoning. I'm not a fan of that strategy. It does happen.
What's the exit when you get shot down? What happens? You just
hand the keys back, or you better have a good backup plan. But I mean, what we're trying to do is take stuff that you're not even close to being able to build what we're building under the current zoning.
Got it.
So for us, it's a deal killer.
So you just pay the slight premium to say, hey, give me 9. It's the opposite of a cash offer.
That's exactly
you get a
right.
discount for a cash offer. You're going to pay a little more to get 9 months.
Right.
Okay. Makes sense.
And then as of right,
sorry, I know you had something.
Yeah. And then as of right, it's, that just means, if for those that don't haven't looked at land, that just means you're building what's within the zoning code. And if you do that, you don't need aldermanic support. You don't need neighborhood meetings.
Got it.
And that's great, but that's hard. That's really hard to find for larger scale sites. 2 of our sites have been as of right, 2 are rezones.
Are you ever offering hard money or anything like that as far as earnest money goes, or making the earnest money hard, meaning that for people listening, meaning that if you can't get it, you forfeit that money?
We have not. That is a strategy that you can definitely use if you feel good about it. If you know the alderman, in Chicago, it still is alderman's prerogative, meaning if your alderman supports you, and you better have that, relationship to believe that that's the truth, because usually it's not in writing. If you go to city council with your alderman's support, you're generally speaking going to have the support of zoning. And that's not how every city works. And that's definitely not how the suburbs work. The suburbs, you have to get board approval, and it does not. I've had some troubles in the suburbs because, I don't know, it's much different. But in Chicago, you could feel pretty good about it if you have your alderman, if they support your project. And so we work very closely with our aldermen to make sure that they agree with what we're planning. They like the use, they like the design, the aesthetic, the height, the density, the parking. And then, but in that instance, would we put some money hard? Yes, we probably would. But you have to feel pretty darn good about it.
Got
it's
it.
Not something I would recommend too much.
Got it. So you said you have a few of these under development. I mean, if some of these were modeled out pre-COVID, I'm assuming your rehab budget is just looking hilarious compared to actuals versus what you predicted. talk about just some of the curveballs that have been probably thrown at you over the last, call it 12 months, 18 months, et cetera.
Yeah. So lumber, unfortunately was really high when we even started looking at these projects.
Okay. So it was already up there when you were.
It was already up there. Fortunately, it has now come down, not to pre-pandemic levels, but to buildable levels.
Mm-hmm.
So we got very nervous mid-cycle when we were zoning these properties because lumber went just to the moon, but we weren't building yet. So that's a risk that we luckily hopefully won't hit, because by the time we actually are building these things, which we're just starting now, lumber's back down. Steel is really high. Everything's high. I mean, all this stuff's high. We have a little bit of steel in our Lincoln Park project. We're over budget on that. Overall, though, we've been able to maintain the budget that we've underwritten to, with some pretty large contingencies in those budgets from the get-go. So we will use some contingency, which is kind of typical in development. Really what I'm more concerned about, and I tell my investors this openly, is just supply chain, and whether or not, when you're building, we have 186 units that'll be in development at the same time over 4 buildings. Are all the doors going to come? Are all the kitchens going to come? Are all the windows going to come? Are they going to be on time? Can we get them to the actual site? And that's, my partner's the general contractor, so I lean on him a little bit to appease our investors' concerns with that stuff. He feels pretty confident we'll get it all. But I think just getting it is just as big of a concern as what it's going to cost us to buy it. But most of our stuff's bought out, and we're still on budget. So we've been fortunate. I think the building type that we're building, again, they're pretty simple buildings, a little bit less moving pieces than some of the larger stuff that is not buildable right now.
So we're walking through like development here, and you mentioned investors. How are you paying out investors? Because there's going to be no return for a long period of time. You're going through zoning, you're doing the development. Like, the stabilization is a long way away, right? Like,
Right.
Are your investors are you paying a pref return, or are they just, you don't have to get too specific, but just general structure?
Yeah. So they
get nothing for the first 18 months. The money's buried, and hey, but
right.
Guess what you get in year 4 or whatever.
Yeah. So, and I can kind of, most institutional level deals are kind of done the same way we're doing ours. So it's a pretty open, it's not a unique structure where there's kind of a GP and an LP. The GP is me and my partner. We control the deal. We do all the work, right? Sourcing, we do everything. The LP is a limited partner, passive investor. Very similar as what I was in at CA when the deals were high rises. And yes, that's exactly right. There's a pref. That pref starts ticking as soon as we take investors' money, the day it comes in the door, and it ticks and it accumulates what we owe them until we sell or recapitalize the project. And then there's, depending on the deal, 1, 2, or 3 hurdles, meaning the way that the developer makes kind of, I guess, call it the profit, or it's called the promote, is over that hurdle, the GP starts to get rewarded as the returns get higher. So some people just have one hurdle.
So does the split change, or you just get like a bonus? There's like the actual split.
There's a split over a certain preferred, where that developer then takes a piece of anything higher than whatever the preferred is. There's a split, and that's called your promote. And that's how the developer makes money outside of fees. And then if you want to call it fancy, you can do what's called a waterfall, where the splits might get higher over higher returns. So maybe after there's a second hurdle and a third hurdle. And once you cross that third hurdle, and there usually isn't more than that, maybe the split goes to like 50-50 or something like that. And so that, to keep it simple, there's usually a pref and then a split. And then if you want to kind of make it a little more complicated, you can do a waterfall.
Got it.
And we've done both.
Yeah. So when the project does well, then you're doing very well. Your investors are all getting paid, but then you're in the bonus round. Things are going really well on your end.
Yeah, that's right. And yep. And to your point about when it's paid out, it's just paid out at the sale. And it all runs through that. Those calcs all run through the waterfall, and then it's distributed at that point. There can be some cash flow if you hold for a period of time. We generally need to hold for a year to not trigger short-term gains. Mm-hmm. Yeah. So generally you have to be leased for a year, or leasing for a year. So there could be some cash flow distribution, but generally I think it's just accumulated and distributed at the sale.
Got it.
So the structures and all that and doing bigger deals is probably appealing to a lot of our audience as they grow. But let me ask you, like, you have these deals, like what size investors or money partner, limited partners are you bringing in? I mean, you don't have guys putting 5,000 in. Like, what's like the threshold for you that you like to have for investors as far as minimum amounts that you're having them invest?
So like we've raised about $20 million across the 4 projects. We were trying to not be like not pure syndicators where we had like 100 or 200 investors. We were kind of trying to limit it to some larger checks just for ease of the raise and the accounting. Crowdfunding. We didn't do anything like that. I know people are doing that now. So our minimums are 25,000. Those are our friends and family, but most are in for over 100. Most are in for over 6 figures. And I would say our average investor is probably about $1 million. We probably got about 20 investors in the deals right now. But yeah, I mean, I think for smaller projects, generally the minimums are 25 to 50 is what I've seen for kind of smaller syndications, unless it's crowdfunding. And then it goes down to like 5 or 1 or whatever.
Is there any thresholds that, and I'm not looking for any legal advice or anything like that, but is there any thresholds as far as like SEC like filings? Are these all private offerings? Like
these are all private offerings with accredited investors.
Accredited
no,
investors.
there's no. We don't have to. We just issue K1s to our investors every year, and file the proper tax returns. We're not that big yet.
Gotcha.
Not yet.
Well, we don't plan to be either. We don't plan to be. We're already as big as we thought we'd be, and we don't really want to get much bigger. That's not everyone's plan. Some people love scaling. We kind of want to just continue to do what we're doing.
Well, I love the model that you guys have. And actually, talking to both you guys here, you guys have both Matt and Tom. You guys have partners that are one you guys might be the numbers. The other person is the construction, and that. I've had that too my whole career. My partner's always been the construction, and I've been the guy that's at least in the spreadsheets. Right. And if you guys just want to speak about that for a second, how huge of a benefit that is to yin and yang off each other. I think that's huge for anyone thinking of getting partnership. Like you have to have offsetting like strengths.
Yeah, I mean, I think that's right. And I spoke to my partner for almost a decade about doing this together before we actually, trusted each other enough, I guess, to do it. And I think, even with my experience with having modeled properties, both on the sell side and the buy side for almost 20 years, and sourcing deals, I mean, I've been doing the same against some of the sell side, but really for the last 10 years on the buy side. I think that I've got more experience than anyone could ever need in that, right? I can model, I mean, Jesus, I don't know if I've modeled thousands and thousands of projects, but building it is different, and it's a different skill set. And, negotiating large contracts with general contractors between $10 and $20 million is not something that someone that's good at modeling is necessarily capable of. I mean, you can do it. Am I going to get a good of a price? Am I going to be able to get the protections I need without my partner? No. And vice versa. He wasn't a sourcing guy. Everything he did just came through brokers, and he kind of just did it, whatever worked. And so, yeah, I think having a yin and yang is a great thing. And when I was at CA, we were doing, a few $1 billion a year of development over the country, cross country. I think our most important guys were the guys that negotiated our GC contracts, because without those being sometimes, $10 million over budget day one, and you had to find that somewhere, those deals weren't going anywhere. They don't get started, and they don't get built on time. So I learned there how important that skill set was to the deal. It's not just the investing side or the sourcing deals, which is kind of what I do. You got to kind of have both to really feel confident you can get these things built. I think at this scale, or have a GC who's a really good friend of yours, or a relative, or somebody you can really trust. So
yeah, 100%. Couldn't agree more. Well, there's a saying, it takes 2 or more flints to create a fire. Right. Like there's at some point, if you want to get to it, like it's not you, it's on you and your team and everyone else. Like,
right.
So I want to go back real quick to, you have investors who love your business plan. They think, all right, your contractor is great. We believe in you. I just want to talk about Chicago in general, right? There's probably a negative perception, at least nationally, of why some of the bigger institutional players aren't here. Crime, taxes, we're broke, etc.
Yeah.
So talk about, some of those. I just want to talk about some of those investor perceptions. And then also, what do you see happening in Chicago? Where do you see cap rates going in the next 12 months, 24 months, et cetera?
Yeah. So you nailed it with those three issues we have. I think those are the top three. People talk about out migration, but I don't think that's nearly as real. I don't think that's happening to the level that maybe some people think that's happening.
We grew in population from 2010 to 2020.
Right. And if you go downtown and talk to any of the property managers, I mean, everyone's back. And so it's a weird time. And let's kind of take the pandemic out of it, because that's going to eventually normalize. The crime and the politics and the taxes, we're not quite there yet on how to fix those. I think the taxes will have some more clarity in the next year or two as these reassessments all get done. That'll be helpful to at least be able to underwrite those properly, because the fear of taxes is more than even what the taxes are.
That just happened to me. I bid myself out of a deal. Lakeview wasn't reassessed yet.
Right.
I overshot what they're going to go to. And then I saw what they actually got reassessed. And I was like, gosh, that's, 10 grand difference at a 5 cap is $200K value.
Right.
And it's like, God damn it. Like, that's $200K I had to play with.
Right. Exactly. So I think once we get a little more clarity there, that'll be helpful. The crime hopefully will get, under control. From an investor appetite, for my deals, again, which we raise about $5 million per deal. So we were looking at high net worth individuals because we could either do a lot of smaller checks or, a few big ones. We started with the biggest people I could get in front of, which are ultra high net worth, call it family office type investors that had more than enough capital to write a $5 million check to one person. Most of their responses were, I live in Chicago and that's about all I want to have to do with it right now. I won't invest here. It wasn't even like, send me the deck. It was just, you could send me whatever you want. I'm not putting money in the city right now because of how mad they are about what's going on. And then I kind of went, okay, well, I'm not getting any money from the wealthiest. And then you kind of go to the mid tier, which I would call, they could give me $1 million, maybe not 5, right? They're not going to write a $5 million check, but they could do $1 million check. And I didn't have a lot of success even with those kind of very high net worth people. I had a lot of success with their second generations, meaning a lot of my investors are people like me who are going to be here for the next, hopefully 30, 40, 50 years, whatever it is. I'm not planning to leave Chicago. I'm going to build in the best neighborhoods in Chicago. And I'm going to, give the buildings to my kids, hopefully, if we can ever figure out how to hold on to them and not have to sell them, which is kind of what we're doing now. So those folks wanted to invest here. They want to see and touch the real estate. The ultra high net worth folks that I was talking to, I'm not speaking for everyone, they see investment opportunities in Phoenix and Dallas and Denver and Salt Lake City and San Diego and Florida, all over Florida. And they see those. So they don't want to look at stuff here because they can go and look at everything everywhere else. If you're not seeing opportunities everywhere, our opportunities look pretty good. If you're seeing opportunities everywhere, then everyone talks themselves out of Chicago. And so that's a long answer of saying I got a lot of no's, not because of my deals, but because of the city we're in. And then as we started to build our investor database, and most of my investors are in real estate. So most of the people that gave us money know what they're real estate people. They're not just blind investors who kind of got to know us. I thought that meant a lot to the other guys that were coming in and that our investor base was real estate people and they believed in our thesis and our projects. But it is an awful time for Chicago. I mean, institutional investment is almost, it's just not happening right now. Few and far between. A deal just to get capitalized in the West Loop for a new high rise. There's a couple high rises in Fulton that are going to get going, but there's not a whole lot else happening here. Yep.
Now, compared to some of those other markets you mentioned, like we do have a higher attractive cap rate. I know it's specific to neighborhoods, but just generally speaking, where do you crystal ball on the table, where do you see cap rates going? With all the unknowns we have, do you still see them staying, pretty compressed or moving one way or the other?
Well, we're underwriting pretty conservatively. For those who don't know what cap rates are, I guess maybe start there. So
let's take a step back. Sorry. Great
an unlevered return on your investment. So meaning if we have no debt, we're going to build like a 6.5 return. If we do the whole thing in cash, it's going to be a 6.5% return. And generally speaking, you want at least 100 basis points spread below that for what you're going to sell it for. We're underwriting to a 5.25 sale. And so we're building to a 6.5, we're underwriting to a 5.25 sale. That's a healthy spread on the new construction development. I mean, should cap rates be lower than a 5.25 on a brand new construction building in Lakeview or Lincoln Park? I would say yes. I think they should be 5. I think they should even be 4.75 where debt is today. When you look at Dallas, when you look at Phoenix, when you look at Atlanta, they are selling. And I know it's Sunbelt, which is what everyone wants right now, but I don't think those are attractive places to live as where we live. They're selling at 3.5 caps, 3.25 caps. So how are we at a 5?
Not just in the A neighborhoods, the whole metro. Right? Metro. Like that's what confuses me is like, it's not their Portage Parks of the world are at 3.5 or whatever. 3.5. And that's what's crazy to me.
Yeah. How are we at a 175 basis point premium to a B location in Dallas?
Yes.
And it's because all the investors flock to the same markets. And so there's a feeding frenzy there now because of the job growth, which is real. It's very real, but you're still getting a worse return. So, we kind of hope that cap rates will actually compress in Chicago down to the 4.75 by the time we're selling in 18 months to 24 months. But no broker will tell you that. No banker will tell you that. So you have to underwrite right now to kind of higher than what I think they should be at. I think downtown high rise, maybe you can get into the 4.75 range right now on a sale. Mm-hmm. But the neighborhoods are still at 5 or north of 5 is everything I've heard. And so let's hope that those go down a little bit. We all can get a little bit of a pop, if that happens.
Yeah, absolutely. Great stuff. Mark, anything to add? Are we good to wrap here?
No, let's wrap. All right. You ready? This is our fire round. So let's hear what you got. So Matt, what's been your competitive advantage? How have you been able to scale your career in real estate when others wish they could do what you've done in such a short amount of time?
I would say, take every meeting, do this type of stuff. I've always been really active in the kind of the networking Chicago real estate world. Join clubs, meet people, be friendly, take calls. Because the deals that have come to me have come through relationships. Deals do not fall from trees. You have to be on the phone. My brokerage experience gave me that courage to kind of meet and talk to everybody all the time. And I think as a buyer, you have to be the same way. You can't expect to jump on the MLS and find the next deal. You find it through a relationship, a meeting, a coffee, is my experience.
Great advice. And Matt is true to his word because we reached out to him cold on LinkedIn saying, hey, we have like 30 same connections. You're in Chicago real estate. We should talk. So,
and you went to U of I.
Yeah. So we had that little there.
That helps too. If you go to U of I, you just automatically get to find some good stuff out there.
All right. So what is one piece of advice you would tell someone that is yet to buy their first property here in Chicago?
I would say understand how to underwrite really well. And, if you need a mentor to do that, find one. It's really all about being detailed and having a real understanding of how the inputs affect the outputs. And, there are people that have done great projects that maybe don't use Excel or don't understand the mathematics behind it. But I think to be a really good investor, you have to understand how to underwrite properly. And ask a lot of questions and make sure you're not making any mistakes there, because that's where you can get burned right out of the gate.
Awesome. All right, Matt, what do you do for fun?
I'm leaving in about 10 minutes. I've got 3 boys that are all in sports. So I drive around from 4:30 to 7:30 pretty much every day from sport to sport. So I have hockey practice with one of them in a little bit here. Personally, I'm a hockey guy, so I play a little bit of men's league, and that's really about it.
Nice. Well, we'll have to see at Johnny's at some point.
Yeah. I used to play at Johnny's. Now I'm at Orbit and Palatine, so way out there.
All right.
Where the old men play.
Well, cool. What is a good book, podcast, or self-development activity that you would recommend to our listeners?
I've done one other podcast. If you want to shout out,
drop it.
Your fellow podcasters, Real Estate for Breakfast. If you've heard of that, it's hosted by 𝗬𝘃𝗲𝗏, who's actually my attorney. And there you go. And he's probably my attorney because he brought me on his podcast. And we started talking, and I went to school with him as well. Real Estate for Breakfast is another one, kind of similar to a little less maybe niche as you guys are with Chicago, maybe a little bit broader. We talked a lot more on that one about kind of the national stuff because I was at CA. But but yeah, it's another one that's a good one for real estate listeners.
But we will link to it in the show. Always happy to support anyone else trying to do this.
Absolutely. Yeah. They're good people. You should definitely connect with them.
Cool. Besides yourself, name one person in your local network you'd recommend to other investors as a quality resource.
And I can't say Philip from Real Estate for Breakfast because you just used them.
Yeah.
They got to use another bullet here.
Okay. Let's see. I mean, I think a good broker, he's really more in the space that I'm in, is a guy named 𝗘𝗲𝗀𝗃𝗀𝗀, who's still at 𝗓𝘃𝗃. He's been there for a very long time. He was just in my office last week, so this week he popped into my head. He's looking at some property that my partner owns. Probably the best valuation guy I know in the Lincoln Park, Lakeview, kind of north side neighborhoods. So he's a very good resource for owners.
Great. We will link.
That's great. All right. So thank you so much, Mark. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you? Anyone's welcome to reach out. My website it looks like maybe you can throw a link up there to it on your page. Yep.
All my information's on there. We're a very small company. It's me and my partner and 2 PMs and an analyst. But we're always, willing to take meetings and take investors on. If anyone wants to look at our packages, we're happy to share them. We're pretty open book, and I think it's a good way for people to learn what we're doing. And if there's a partnership out there, one of the things that we have done is kind of opened up our database and our relationships to partners. So if someone has a project that they maybe can't get off the ground, that's maybe too big for them, that fits into our thesis, there's always ways to joint venture too. So they've got to be a little bit larger, kind of 30 units plus, but we'd love to talk to people that have something like that potentially on their plate.
Awesome. So just one quick side note for those of you who are listening to this. We started this. This is the winter quick sundown. It's completely now dark in Matt's room. It was fine when we started the podcast, but now it's completely dark and he hasn't gotten up to turn the light because he's been talking.
Yeah, I'm sitting in the
It's just sitting in the dark.
Yeah.
That hour was the sundown.
Yeah.
All right.
Exactly.
So we got the Chicago fact here. So Mark Ainley, you get first crack at it here. So Chicago's GDP, it's the third largest in the U.S. And we're talking the whole metro here. So like the 10 million people, counting your Naperville's, Elgin, Schaumburg, et cetera, the whole metro. It's north of $700 billion. If Chicago was its own country, there would only be this many countries with a higher GDP. And I'll give you multiple choice. Is it A, 10, B, 20, C, 40, or D, 60? 10, 20, 40, or 60. This is the amount of countries that would have a bigger GDP than Chicago if Chicago was its own country.
I thought it was around 18 or 19, so I would say 20.
All right. Matt, what are you going with?
I'll go 10.
This whole episode, I've been calling you Mark and Matt because it's freaking confusing. So sorry about that. No, the answer is 20. It would be 21, just ahead of Switzerland.
I knew it's crazy. Wow. Yes. I'm telling you, I get so excited when I get the question. The rest of my days, I always awesome Matt for that. So
I got to listen to this recording. Did I call you Matt at all? I know I called him Mark a few times.
Oh, no, I didn't notice.
All right, Matt, Tom, awesome show. This is great. We talked about, I love the episodes where we talk about things that we've never talked about before. So we definitely got a lot of that conversation out of this show. So thank you guys very much. Listeners, please leave us a review. Please refer us any other potential guests that you think might add value to the rest of you. So especially if you went to U of I, I'll throw one more dig in there. If you know anyone that went to U of I and it's ever like bought a piece of real estate, we'll have them on the show. So thank you, everybody. Leave us a review. That helps us grow in the rankings, reach more people. We get more listeners, we get other guests, and we keep growing. So we want to grow with you guys as you grow your portfolio. So Matt, Tom, thank you very much. And talk to everyone soon.
Awesome. Thanks, guys.
Thank you.